My name is Jose Macedo, and welcome to episode 3 of the Hivemind podcast. We all should have much better mics today. We got a lot of complaints about sound quality, so that should be fixed. And as always, the goal of the podcast is to provide an inside look into what we like to call the Delphi Hivemind, bringing together some of our brightest minds from each of the divisions to share insights, alpha, and shit posts. Today with us we have Ceteris from our institutional research arm, who focuses on blockchain infra and DeFi. We have Jan Lieberman, who's the managing partner at Delphi Ventures. And we have Ventures associate Duncan, also known as Flood Capital, prodigious shitcoin scavenger and investor. I lead Delphi Labs, our protocol R&D arm, focused on incubating and accelerating new Web3 primitives. And we also have Matt, also known as OX DeFi, who heads up research at Labs and is a general gigabrain on AMMs, which is going to be a lot of the topic of today's chat. It's been a bit of a stale news week in crypto, maybe news month. So we're going to be talking about the future of on-chain liquidity, which is our research recently published a report on it. Check it out if you're a subscriber. But basically, this conversation is going to be around whether there is a future for on-chain liquidity or whether everything is just going to move to off-chain. And so to start with, we just want to go over like a brief history of on-chain liquidity, starting back in the Ether Delta days. Ceteris, take it away.
Yeah, so basically the first on-chain liquidity was like using this Ether Delta, and this was a fully on-chain order book, and so you would actually have to
this was like 2017,
do a transaction,
right?
2017, right? I would guess like 99% of stuff that was traded on there is like effectively zero now, but you'd have to do like a transaction to deposit into the exchange, and then you do another on-chain transaction to like place and cancel orders. And this was on Ethereum with like 12-second block times. And so it was a very expensive and very inefficient system. And before DeFi summer kind of came around, as it was kind of workable still because gas fees were so cheap because no one was really using like Ethereum L1 or anything. But as soon as people started using it, it became clear that like, okay, this fully on-chain order book is way too expensive. Like it's not practical. Okay. And that's when AMMs started coming out with stuff like Curve and Uniswap.
Well, it was Uniswap first, right? Like Vitalik put up this XY equals K, then Hayden built it as like a grant, I'm pretty sure, from the EF. And then it started kind of.
Yeah. I'm not sure which one was first, but like the big thing that AMMs solved is that they were workable in a gas constrained environment, right? Because you don't need to, as a liquidity provider, you don't need to keep doing placing and like canceling orders. When someone takes like one side of the pool, you automatically kind of like flip to now offering the other side, right? So this is like why AMMs took off, is that you're in such a gas constrained environment. And this kind of got around those gas hurdles. And then second of all was kind of just like all the rewards and all the farming that people were doing, right? I think synthetics was probably one of the bigger reasons why people started LPing, right? Because they started doing all this SUSD stuff. And then they were big on Curve. And like some of those early LPs LPing SUSD on Curve, like massive airdrops, right? Like millions of dollars airdrop.
And ETH, synthetic ETH and regular ETH.
Yeah, and it's like a very simple pool, right? Like it's just ETH against ETH, and this synthetics doesn't go insolvent. Like you have no impermanent loss or anything. And yeah, so that's kind of like how these AMMs took off. And then of course came the whole DeFi summer. Curve did their airdrop. Then Sushi forked Uniswap, and they started pumping out the token rewards, right? And so when it's like a bull market and no one knows how to value these farm tokens that you're getting, right? Like how defensible is this income that LPs are getting and all this? That kind of led to the mayhem of like on-chain AMM farming, that whole craze. Uniswap did the airdrop. And so that's kind of like how the whole on-chain liquidity started.
And it looked for a while as if that's where it would stay, right? Like most projects would launch with like LP incentives, like yield farming was all the rage. I guess kicked off by synthetics, yeah, and then things took a dark turn.
The other thing that I'll add to this is it was in a gas constrained environment. So yes, like the AMMs got around those constraints, but also being fully on chain made it decentralized, and people started to realize that if there was a significant massive liquidity in these pools, they could really launch tokens in a decentralized way without having to negotiate with exchanges or hire market makers or trust third parties. And so as people were creating these new ecosystems and wanted to create a token to incentivize certain behaviors, having on-chain liquidity and being able to bootstrap that on-chain liquidity by giving rewards. Wi-Fi, their launch was one of the first people that did this. Really started this, the DeFi summer revolution of if we take some of our token supply and pay people to LP, it's a valuable service to us, and it's going to get us more distribution, more users in a fully decentralized way. And I think that was pretty novel.
Yep. Yeah, maybe Ceteris, you want to go through like when things started to change? I guess like 1 inch and
yeah,
intense.
I mean, well, so that's kind of how it started. And then he had all these aggregators pop up, and those were good for traders because now instead of, if you go through Uniswap, it wrote through Uniswap pools, but maybe not all these other AMMs that popped up. And so that was good for traders. But over the past, I guess, year or two, people have started to realize how much money LPs lose to basically just toxic flow and arbitrage. Because since an LP is passive and doesn't update its prices, every time the price, price discovery happens for all the liquid assets on centralized exchanges, right? So anytime the price changes on a centralized exchange, you now have these stale pools on chain. And so a big part of on-chain volume has just been people arbing the pools from like centralized exchanges, right? And so this whole like loss versus rebalancing thing that people have been talking about a lot over the past year is kind of this phenomenon, right? Where if ETH is trading at like $1,000 and it spikes to 1,100 on an exchange, the LP on chain will effectively sell from 1,000 to 1,100 in like incremental ticks. And so 99% of that trade is at a stale price, right?
I think it's helpful to kind of put that just to understand how it works relative to kind of IL as well, just to kind of rewind. So IL, impermanent loss, was kind of the main initial concern with LPing. And the whole idea was IL just says, if I'm holding two assets in equal quantities, and you compare that to putting those two assets in a UniV2 pool, when price moves from X to Y, how much did my AMM underperform the buy and hold strategy? And so and then the idea is why it's called impermanent is if price goes back from Y back to X, the two are equal, right? Both the value in the AMM and the value of your buy and hold strategy. What LVR basically is saying is, when it goes from X to Y back to X, you actually shouldn't be sitting with your starting value of assets. You actually lost money and you should actually have more. And the reason being what Ceteris kind of described, where, price is because loss versus rebalancing is basically you comparing the performance of the position in the AMM versus someone replicating the AMM strategy, but doing it on Binance, right? So the idea is
it's kind of like, if I can just jump in, it's kind of like how much money you left on the table.
Yeah.
Like, what do you leave on the table?
Right. And so price pumps, like 1%, right? So you start at $1,000 ETH, price moves to 1,010. The decision tree is, okay, I need to sell some ETH to go back to 50-50. I'm selling at $1,010. On the AMM, that's more of a price taker, and so those rebalance late. So basically what happens is the price pumps to 1,010. The AMM is effectively still selling it at 1,000. Like, you can go into the AMM and buy it at 1,000 and move it to 1,010. So the AMM, the liquidity provider in the AMM, instead of selling it at 1,010 like you did on Binance, sells it at basically the midpoint between 1,000 and 1,010. And so that kind of over time is the issue. And so part of the reason why it's useful to do in that context is kind of, with those difficulties in mind, who is kind of the ideal, like where does it make sense to be an LP, right? So it's
I don't want to get into that too much now, though, because we're gonna get into like the LPing and AMM stuff later. Maybe just continuing to like that was useful context, but continuing to set the context. Like 1inch came about, then I guess like CowSwap, eventually Uniswap X. The difficulties with and inefficiencies of LPing meant more and more of volume has flowed to those, which are effectively being served by like off-chain market makers and centralized exchanges, right? And then I guess that plus like off-chain order books with the likes of DYDX and Vertex and stuff means that a lot of price discovery sort of always happened off-chain, at least for the majors, but you're starting to see that like also trading volumes and stuff move more and more to these off-chain solutions, right?
Yeah. Well, I mean, the off-chain stuff like CowSwap, all these intent-based protocols, Uniswap X, the whole Anoma thing, that is better for traders, right? Because you're not getting sandwiched. Like when you sign when you want to trade against an AMM on chain, you're signing like this execution path that says, I want to go through this pool and I can afford this amount of slippage and just get it done. And so, everyone who's on chains probably had a bad sandwich or two in their lifetime, which is just, someone in an advantageous position, essentially reordering transactions to make you lose money. And so with these intent-based designs, they're kind of like limit orders. They happen off chain, and then they're based around solvers. And so something like CowSwap, someone goes in, I want to buy 1 ETH for X USDC, and then a solver goes to like look to fill that. And they can use their own inventory. They can use pools on chain. But basically, they're trying to like fill that order directly. And so the shift in moving to this kind of like intent-based architecture is that for liquidity providers on chain and these AMMs, they start to get less of the organic flow because now when this like retail trader with no alpha, no like knowledge, whatever, comes in, instead of going directly through the pool against the AMM, they go to this solver, and the solver has their own inventory, and they have money on centralized exchanges, and they're the ones that like are able to fill this retail trader, and then the solver just goes and arbs the AMM pools themselves. So the AMMs are now starting to get like more and more of just this toxic flow, which is, they were always arbitraged against CeFi exchanges, but now that they're also losing some of the organic flow, the ratio of their toxic flow goes up, and then also their volume goes down a bit because you don't have the organic volume anymore. And so now we're kind of, we did everything was AMM. We've had all these intent things are coming along now. And now we're kind of moving. You're going to start to see AMMs kind of like defend this now, right? And kind of like fix some of these problems. And I don't know if we want to get into that now.
So I guess that's basically like the bear case for on-chain liquidity, right? It's a future where we move to this fully intent-centric model. It is a future where you don't really, like, AMMs would just be purely exposed to like toxic flow or mostly toxic flow, and then eventually no one wants to LP, and like all price discovery moves to these like intent-based off-chain models. Is that right? Is there anything you'd add to that? Like before, because
no, that's right. Like also the intent architecture, it's also not just like AMMs, it's bridges too, right? Like you don't need these passive liquidity bridges either.
Yep.
It's a lot of things. If you go to like the extreme of the intent architecture, then applications are merely front ends with their own solving algorithms. And blockchains are basically just used for settlement of assets. But a lot of the complexity happens, in this off-chain and like in this peer-to-peer gossip layer. And so like, I don't know if that's the exact end state we're going to go towards, but That would be like the full-on bear case for on-chain liquidity.
So what are like the negatives of this if that happens?
Yeah, I
Like,
mean
what
it's more
would be the
centralized.
negatives?
It like regulatory pressure. Basically, everything that is, in my opinion, everything that's easier is also a bigger regulatory target. And so think about like the L2s right now, okay? The L2s are all taking extremely easy paths. They are multi-sigs with a single sequencer, okay? And so they can offer like a clean UX. There's not a lot of like complications, the architecture, but it is most likely like an easier regulatory surface to attack, right? And then if you think about like solvers and intent architectures, if you have like 2-3 solvers that are filling like all the orders on blockchains, then that again is an easy regulatory target, versus if you have all this passive retail liquidity that's all over the place, it's less efficient, but it's also just this massive, can't go after like hundreds of thousands of people, right?
Yeah, because like the solver is essentially just bridging Binance or wherever the deepest liquidity is to the user directly on the blockchain and like using it as settlement, right? So I think that's where like I definitely agree with like the bearish AMM takes. I feel like I've thought that for a while because they simply just like don't have as much information or complexity as the solver. But I think this is where like some more complex like Oracle models,
Let's
which we didn't really
like,
touch
hold off
upon,
on that
like,
for a second. So yeah, we will get into that. But so yeah, I guess we went through over the bear case for on-chain liquidity, and now yeah, we're gonna move on to like what the bull case is. And I guess it starts with the fact that even though everyone knows LPing is incredibly unprofitable, there have been like 3,000 studies on how everyone is losing money on UniV3 and UniV2 and stuff. There's still like billions of dollars of demand for LPing on chain. And like that's kind of like hard to argue against, right? And then I think the argument that people like Matt would put forward, and I think Jan to some extent, is that if these like highly, and myself actually, is that if these highly inefficient models can attract billions of dollars of capital, there's something here. And as the models improve, which they are, and we're seeing like really cool stuff happen, then they'll capture even more of this flow. And so I don't know, Matt, do you want to give like kind of your thoughts on I guess like the bull case for on-chain liquidity?
Sure. I mean, I think having on-chain liquidity at all is really valuable to lots of different people in the ecosystem. It's really valuable for traders to have on-chain liquidity so that they can trade against a decentralized source. It's really valuable for issuers to have on-chain liquidity so that they can bootstrap it really easily. When it is that valuable for them, they offer incentives. So like in DeFi Summer, we saw a lot of incentives, and a lot of people thought AMMs were like these magic money machines with triple-digit yield. We're not seeing that so much anymore. People offering incentives, they're offering incentives for a reason. It's because that liquidity is valuable. And I think we're seeing a lot of LPs lose money right now because on Uniswap, there's not a lot of incentives that are external.
I mean, the volumes are down too, right? So like you're getting less trading fees.
Yeah, you had all the money flowing into the space, and then like a bunch flowing out.
But the liquidity mining stuff isn't really like sustainable though.
Well, people are underpricing the service. So like the LPs that are putting their money into these pools, the fees that they're collecting are not commensurate with the risk they're bearing or the value that they're providing to those other people. And even with off-chain liquidity, so like a market maker that is hired by an issuer, they're giving that market maker either money or some kind of sweetheart option deal to hedge away the risk, or the exchange is giving them rebates. So like a lot of the profit for an off-chain market maker comes from these external incentives. So if we're looking at on-chain liquidity to compare apples to apples, you kind of have to include those incentives as well.
Nobody actually wants to trade these assets.
Well, what I'm saying is like if you look at a market maker purely on a like inventory P&L basis, a lot of them are losing money too, because market making is hard, right? You're not really taking an opinion on which way the price is going to move. You're just saying, give me money for providing you liquidity, for providing this service.
AMM. So this is just like more on the bull case for AMMs, just before we kind of veer off this. So, it's, I think a lot of people are losing money on UniV3. I wouldn't really put UniV3 in the AMM bucket, right? It's not automated. It's basically an order book, but like without the benefits of being able to do that type of market making on a centralized exchange. So it kind of boils down to, where can it make sense for someone to do this completely passively? So the intent stuff is beneficial for the trader side, but there isn't a lot there's still the issues with the LP side. One of it being the fact that LPs are constantly taking stale prices, and so LVR is really hard to completely undo. But there are things you can implement, whether that's, and this isn't exhaustive by any means, but a dynamic fee. So LVR is worse the more price moves, and so if you have a dynamic fee which increases as the size of the trade increases, that's something that can help mitigate it. Using an oracle for the AMM, right? So the pool isn't trading on a purely stale price, but it can use an external oracle price, which introduces some kind of centralization risks. Or you can do the decentralized kind of equivalent, which is what Curve V2 does. So I think a lot of those types of kind of implementations can help reduce LVR. And then, you're kind of rationalizing it. So then you think about, okay, so who is the user that wants to LP? I think part of it is based on your opinion on price direction, right? If you're bullish on an asset, then more often than not, it's really hard to rationalize LPing. But if you are pretty neutral on it, you think we're range bound for an extended period of time, and or if it trends higher but doesn't necessarily go up too much, or if you don't necessarily trust yourself to be able to sell when it goes up and you kind of want to gradually sell as it goes up, I think there's arguments in that scenario where it makes sense to kind of LP. It's not necessarily like it's I think it boils down to what you're comparing it against. If you're just bullish on the asset and want long exposure, then there is no scenario, or almost no scenario, where it makes sense to LP. But if you're pretty neutral and want to generate passive yield, then I think there are some of these solutions that help avoid LPs constantly transacting at stale prices, and improves kind of their experience by reducing the LVR. And I think in that scenario, you can really begin to kind of rationalize LPing.
And yeah, Matt, sorry, Matt, I know you have a metaphor I really like with index funds. It's like maybe like it's the hopium meme a little bit, but yeah.
This definitely might be hopium. But if you compare like investing to market making, so the conventional wisdom for a really long time was that investing was this very specialized skill set that only the best people in the world could do. It was kind of this like black box of people who could make a lot of money investing. And then index investing came along and said, like, you can just kind of do this passively. Most of the people who pretend to do this aren't very good at it and don't really beat the index. And then passive investing became this huge boom of an industry, and there was a huge market for it. Market making is very similar in that there's a small number of people who do it with a very specialized skill set, and it's sort of this black magic voodoo that people don't really understand how it works under the covers. Maybe there's a place for passive market making in the same way that there was for passive investing. And I think like the fact that a lot of LPs are losing money right now means that they're not pricing their service appropriately. They're not pricing selling volatility appropriately. And there's been very little experimentation with how fees work. A lot of the fees on AMMs is like flat 0.3%. No market maker in the history of the planet has said we're always going to have a 0.6% spread no matter what the price is, no matter what the volatility is. It's kind of a brain dead market making strategy. So I would love to see more innovation in how fees work and how LPs charge for the service that they're offering both to traders and to issuers and to exchanges and things like that.
Yeah, I think like to add on that, like the psychology is a big reason. And humans are like not necessarily rational, especially in markets. And this is like why people always want to try and outperform the market and outtrade, even though all the like data on it shows that most traders like lose money, right? But it's kind of like that Arrested Development meme. It's like it didn't work for them, but it might work for us, right? And so you're always going to have people that will, like, no matter how much of the data shows them that they're probably losing money, will try it. And some will be successful, right? There's also just the fact that people want to do stuff with their assets. And if you have like ETH in your wallet and you have some other asset that is like kind of correlated to it, it's much easier to like rationalize and justify, you know, doing something with those and kind of like trying to LP with them because like people will have these assets and they want to do stuff with them. And so I think that the market will come up with better solutions that we're kind of seeing now, where you kind of, I don't think LPing needs to be perfect, but you need to be able to capture a lot of that CeFi DeFi ARB, because that's like the main place where LPs lose. And so if you get some of these AMM designs where you have like these top of block auctions, right? So when the price changes on a centralized exchange, that first trade into the AMM, instead of like a searcher coming in and bidding up to the proposer and then all the value going to the proposer and the searcher, instead the AMM itself becomes like aware of this auction. And so that bid to be the first one to ARB that pool actually ends up getting distributed back to LPs, right? And so mechanisms like that we're going to see way more, because if AMMs don't become more aware of like what's happening off chain, then they will go away. And if you can recapture a lot of that CeFi DeFi ARB, then I do think that will be like good enough that you will see a lot of passive liquidity still, because passive liquidity, it's very useful. Like especially people like die with their keys too. And like you just have this liquidity sitting there forever. Like,
yeah,
it is kind of useful. Like it is useful to have that for like liquidations, for DeFi, like for everything.
Yeah, but useful to the traders.
Admittedly, not useful to the dead person.
If LPing,
yeah, I guess it doesn't really matter to the dead person.
If LPing passively can be made into a profitable endeavor, then you have this new avenue to take idle assets and make them productive, which is like a huge product, right? There's a lot of people with idle capital that want to make it productive, that, you know, they put it in products like bonds, they try to lend it, they try to do lots of things to make that capital productive. And if LPing is a way to do that, it's a huge product.
Duncan, I'm going to let you loose in a second, but I guess what we're hearing is AMMs. There's interesting improvements that can be made, like the top of block auction, like playing with variable fees, Curve V2 style, doing more experimentation around that. And if those improvements are made, given the demand there is already, like we think this could go up even more, and it could become a way of passively generating yield on idle assets, right? And this also has a bunch of benefits, like you said. And I think importantly also the other model has a bunch of costs, right? Like integrating with like onboarding with a centralized market maker requires like negotiation. Often they're pretty extortionate. Like you have to onboard into a centralized exchange. The market maker has to have the regulatory sort of like risk appetite to trade these assets, which is getting less and less the case. So like there's a bunch of benefits to having this on-chain always on liquidity, also for protocols, for liquidations, for stuff like that, and all that I guess has to be priced into this. But Duncan, I know you've been raring to go. Give us your go on.
Yeah, but yeah, so I definitely think there's cases where it makes sense, like in the current state, like passive liquidity or on-chain liquidity in its current state makes sense. Like, for instance, we're talking about a protocol wants liquidity on their token. You know, I'm not a massive fan of like liquidity mining, but something where like the protocol were to deploy a bunch of its like governance token in like a Uni V3 like LP range, and then like, you know, as if the protocol is successful, people buy that and they like have like protocol and liquidity as the price goes up, and they can kind of like provide their own liquidity. That's a lot of what GMX is done. Something like that I think makes a lot of sense. And like from the protocol's point of view, right, like they don't really care that much if they're losing, versus what they could be doing on like Binance market making, because like you guys said, like for them it's worth it to provide liquidity for the token. Also for like smaller cap tokens, like it doesn't really make sense to use an order book or off chain or Oracle. So like being able to deploy like a new project with like a little bit of liquidity in an AMM, I think makes sense. I think like the big point, and I agree with like everyone, that these AMMs are going to get better over time, right? Like Matt said, the Uniswap pool doing like a 3 bips fee is just insane, like regardless of the market conditions. So we've seen stuff like Curvy 2 where like as volatility increases, like it'll increase the fee and the spread, like kind of like a market maker would. Market maker would like pull the spread out during more volatility. So I definitely think there's gonna be like smarter models. What Ceteris is talking about, like the auctions to capture the CeFi DeFi ARB. I think what it comes down to probably at the end of the day though is that like these on-chain systems, if they're like truly automated, are never going to like have as much information as kind of like a market maker or like someone running these solvers. So it's going to be very difficult for them to be as like performant in all scenarios. But I definitely think there's things where you could kind of like help bridge that gap, where it's like instead of just like DeFi being a front end into Binance through like all these solvers, you can have like passive pools of liquidity on chain, and then like some slightly more complicated Oracle model, which will try and get you pretty close to what your execution would be on a centralized exchange, but also like having that liquidity on chain, and it can't just kind of like disappear versus like these like front ends and solvers. So like some sort of middle ground, or even like, I don't know how you would like solve the kind of like alignment problem here, but like, if there's capital on chain, like you have a solver like quote for the pool, they'd probably have to take some sort of fee or some sort of alignment problem there. But like passing information from like centralized exchanges and like the place of price discovery and liquidity to on chain, I think is possible. I just think it's like really inefficient to right now, because like the models for AMMs we have are like really inefficient, and then you run into also like the gas issue where like, as we've seen with like Curvy 2, I think it's like twice as expensive as like a UniV3 swap, which when gas gets pricey on Ethereum can make like a really big difference. So like if you're going to continually make these AMMs more and more complicated, then like you also have to factor in like gas in that execution side. But I think there's definitely like a path forward. I just think like how they are in their current state is pretty bad, and they're never going to be as good.
And to be clear here, we're talking about like for the majors, right? Because for long tail tokens where price discovery happens on AMMs, like the Rollbits and on-chain things of this world, it doesn't matter, right? And I think AMMs will continue to be the best for that for foreseeable future.
Yeah, I mean, I think it makes sense though, right? You aren't able to, you don't have the skill set to do what a centralized market maker does, and so an exchange, and you don't actually have to do any work, right? It's the idea is set it and forget it. I've similar directionally similar returns, but worse on all fronts.
Can we maybe spend like a segment, like each person like name dropping some projects that they're excited about in this space, like that in the on-chain liquidity space, or approaches that you think are interesting? I was surprised, Duncan, that you didn't put like a GMX v2 shield in there, so I'm now giving you the opportunity to.
Yeah, well, yeah, I think like GMX, so they came out in maybe September of 2021, and like right away, I think they started getting like a lot of traction because like they're the first people to like really make the Oracle model successful, and for BTC and ETH. And they've essentially,
and a lot of people think it's just leverage trading, right? So like maybe you could clarify like the spot side, because I think most people don't know about that.
Yeah, so like V1 launched and is basically like a pool of like Bitcoin, ETH, and some stable coins, and they allowed like 2 different types of trading. So margin trading, right, or leverage trading, where you could essentially just like go long on BTC or ETH by like kind of renting out the assets in the pool. It had price feeds and oracles to like Binance and kind of like the top exchanges to give you like a fair price. plus like a set fee to kind of reduce the ability for like people to arbitrage, because there's like obviously a little bit of latency in the Oracle. But then they also like allowed spot swaps between BTC, ETH, and USDC up to like, you know, really large size. And especially in the early days on Arbitrum, that was probably the best way to kind of swap between those three assets, because like the Uni V2 or V3 pools didn't really have much liquidity, and GMX would give you like the Binance level pricing. And then they kind of like iterated beyond that, where it's just like, okay, we're just going to take the flat Oracle plus 10 bips to their V2 model, where they're kind of factoring in kind of order book depth. They can kind of go down the longer tail of assets, because like before, how they were like limiting manipulation is like, okay, you need to buy like a lot of BTC in order to move the price like more than 10 basis points. But you know, that's not really true with every asset. So they've kind of gone down the list of long tail assets they're offering. It's still like primarily majors, but in the future they're going to try and open it up as much as possible, and they're going to factor in kind of like order book depth, like on-chain depth, to try and simulate the best sort of price. And then from the LP's point of view, they're not taking still prices, as Ceteris said. So I think a really good example that just happened this week was the BTC ETF news, where BTC's up like 5% in like a minute. And it's like, if you're in an AMM or like anything that doesn't have like real-time data getting fed into it, like you took still prices like all the way up on that move, and it happened to be fake, so it retraced it, but you still have like the LVR issue. And if it were to be real, like you got kind of screwed in any sort of passive product. So at least with like an Oracle, even though liquidity is still sitting on chain, you have some of the decentralization like benefits. It is updating in kind of real time, so you're not getting just like really bad execution when the price gaps up like that.
That's interesting. I know. Does anyone want to respond to that, or otherwise I'll give the floor to
Yeah.
Ceteris to discuss. Yeah, go ahead, Matt.
I think Oracle models, especially for perps, are super interesting, and we're seeing so much of the volume that used to be in spot trading on chain move to perps, because if you are just trying to get exposure to assets, perps is just a much better model. And the Oracle perps pioneered by GMX and GNS, it's seen so much usage. I think they do have a scalability issue, because they require Oracle prices from some source of price discovery that happens off chain. And so if you have more volume running through your exchange than is happening on those external exchanges, you have manipulation attacks and trouble kind of scaling past the amount of activity that's happening on those centralized exchanges. And you're also dependent on those centralized exchanges for a source of price. So it's not truly decentralized in the end. So I think they're super interesting models, and I think there's product market fit there. In terms of like end game of decentralized on-chain trading, I think A, it's not spot, so like, you know, you can't really hold the assets, and B, it's got a scalability issue and decentralization issue.
I was gonna say, I think that the scalability is yeah, I agree. It's a concern, but I mean, most of these markets, right? It's you kind of have power law, where it's the BTC pair, the ETH pair, and like Sol and a handful of others are just making up most of the volume. And so because it's like these guys actually benefit from the fact that you have this one exchange that dominates all the volume, right? Because typically, you know, you end up having to do it like on a combination of exchanges with a lot smaller volume, but because you have this one massive whale that's taking up so much market share, it simplifies the Oracle process, where you basically kind of just use them, and then you can add in some, you know, kind of slippage based on the order book depth on those centralized exchanges. So I agree. Yeah, there's definitely a limitation issue, but I think there's still so much kind of capacity for that limit to grow. And part of the Oracle element is really useful here, because it allows for, you know, every dollar of underlying LP liquidity in your GMX GNS to support a lot more activity, right? Because and so it makes the LPs a lot more capital efficient, and I think they don't have to deal with LVR, and you also get the benefits of being the counterparty to traders, which generally lose over time as well. And so it's I think that's also part of what might kind of cannibalize long term the demand for on-chain liquidity for some of these majors, because yeah, it's hard to argue for.
Yeah, for the majors for sure. I think like long tail assets, or like if you're launching a new token, the presence of these kinds of Oracle based exchanges don't really help you. So like it's a different product than somebody trying to launch a token and bootstrap liquidity.
I think the Oracle model it's interesting. I guess my critique against it is just that you're like relying on an Oracle, and like I have seen some of these AMMs that use Oracles before kind of like misprice at times. I think the cleanest. I just think that the top block auction is the cleanest because you're not really relying on.
Can you talk about the
outside
projects that are doing that, or?
Yeah, I mean, Skip is like the first one that's done it, right?
That's on Cosmos.
Yeah, it's on Cosmos, and I mean, there's not an MEV there, so you don't see it too much. But basically, at the beginning of every block on Osmosis, if someone wants to be first in like first transaction in that block, there's a bid for it. It's like a separate part of the block that is done with this like auction, and then all the value. Let's say the price moved by like $10, and so the value of that bid will be bid up to like $10, and then that all gets redistributed to. I mean, in Osmosis case, it's like stakers of the token; they can choose where it goes. On Ethereum, there's like different ways to do this. Sorella Labs is doing it where they actually have a contract. So they have their AMM pools, and then they have another contract, which is the only contract that's actually allowed to trade against those AMM pools. And then that contract runs the auction, right? And so it's the cleanest way to like recapture that value because you're just solely relying on like this auction mechanism working, and you don't have like an Oracle that you're dependent on or something like that.
And since they're the only like entity that can trade against it, do they like solve like they don't leak much value to like the builders or right?
That's the point. Like that's the thing, right? So like all the value
recaptures it for
is
LPs.
being, and that's where like AMMs are going. Like all the value is being captured by searchers and proposers, right? And proposers actually don't.
Right now, you're saying.
Yeah, right now, and proposers. They capture a lot of MEV from just like standard ARB, like rebalancing pools and everything. But the percentage that they actually capture from these CeFi DeFi ARBs is small, right? They have like less bargaining power in the sense. And so the searchers doing this because like they take on this big inventory risk and everything. They actually make like a good chunk of money from this. And so if you can just shift a lot of that value from like if you can't ARB the AMM without doing like the auction, it just solves a lot of
no, it does seem
problems.
like it solves a lot of the problems in like a scenario like the BTC scenario, like gapping up or like something where like in a traditional sense market makers would like widen their spreads or like pull liquidity. Is it as effect like can it react to those scenarios or like what would happen?
Well, it's just like it's like natural competition. If you only had one person for whatever reason put a bid in, then they would win. Mm-hmm. But if there's a competitive marketplace of searchers that are going to bid in this auction, you want to be first in the block, right? And that goes to the highest bidder, right?
And what is like the underlying pool, or is it all through this auction mechanism? Like, is there like a curve or something, or?
Well, yeah, you can still have like an XYK type pool that it's like a side. It's like the auction value. The pool still gets ARB'd because it's still XYK, right? But there's like this side, like a tip, right? Like tip your LP. Mm-hmm. And then that goes to them too as kind of like a side piece, right? Yeah. So if the arbitrage is going to make a searcher $10, all these searchers that are all trying to ARB this pool are going to bid close to $10 to be the first in. And that's just like a very clean way to make LPs a little bit better off.
Yeah, no, I like
without relying on like outside shit.
That makes sense.
And like right. just on like they're not charging fees enough too though. Like this week Uniswap added 15 bips to their front end, right? And Uniswap LP, they charge like 1 to 5 basis points. So that right there, and I think they're on pace for like, if people actually keep using Uniswap front end, like 30 million or something over the course of a year.
Traders have shown to be not very price sensitive in terms of like retail flow. It's the reason MetaMask swaps continue to be used quite a bit. MetaMask is charging 85 bips. Yeah, it's all airdrop farming. It's not real activity.
That's like, as a side note though, this is the hardest thing about being an analyst, is that whenever you're looking at data, it's like, all right, is there a token yet? And how do I like adjust for this? Because I remember when I was doing the Wallet Wars report, MetaMask has great numbers for their in-wallet apps and everything, but I think I don't know if people are still expecting that though. I think people spent a lot of money trying to get an airdrop there, and I'm not sure that's going to happen anymore.
I think the other cool thing about so we kind of landed on improved AMM models and like Oracle models being like some of the most interesting, I guess, forms of on-chain liquidity in the future. I think the other thing that's interesting about the Oracle model is you can really trade any asset, at least with like a GDAI like gain style model or these like synthetic models. You can trade any asset without actually having to onboard a market maker to trade it, or like bootstrap liquidity in an LP pool, or have the asset on chain, right? Which I think is really powerful. And yeah, you mentioned the Uniswap labs taking 15 bips. Some people were melting down on Twitter about it. Does anyone have any interesting takes on that? Like, is anyone super like outraged by it?
I'm not outraged. Like so they obviously never want to do a token. Like that's something to kind of point out, is that the only reason I think they launched the token to begin with was because of SushiSwap's vampire attack. And this is I guess one of the problems, is that you have like equity and tokens in a lot of these protocols. And it's just like, this will just encourage people to use other front ends, I guess. Just stop using Uniswap front end. I think Uniswap. So my thing with Uniswap is that I'm not even sure that in 3 years from now people think of them as AMM protocol. What they're trying to be is just this consumer finance application. And so that means the front end, it means their wallet, like their app, right? Like, go to Uniswap to do literally anything you want on chain. And especially, moving towards Uniswap X, which is small right now, but I imagine it's going to be used for a lot. And I think Uniswap X is going to kill a lot of these bridge protocols too. Okay. Because you can do like bridging, you can do cross-chain swaps with it and stuff like that. And so Uniswap is every good application is its front end. Like, that is what I kind of think the end state is. So I'm not surprised they did this. I'm not outraged they did it. What ends up happening is that the people who pay this are like new entrants, right? So like the bad side of it is that the people who get screwed here are like the noobs, because they don't like understand
it's
all this stuff
noobs
that's
and,
going
and
on,
like
and
retail
everyone
uni
else will
holders.
just use aggregators.
Because everyone else who's like uni holder from the beginning, they're up massively, even if it kind of keeps trending down, right? Like relative to what they bought in. So it's irrelevant for them. It's kind of everyone else who bought in expecting the potential for a fee switch. And I think this just makes it less likely. It's kind of, a reflection of their regulatory risk aversion and kind of like,
I think it's like perfectly reasonable if you run a front end, operate like servers, like take the regulatory risk of doing that you charge a fee for it. And I think if anything, that should be like the business model for like crypto apps. Like, you have sort of contracts at the base layer, and then a bunch of front ends competing to capture user flow and charging fees on top of it. And I'm a big fan of like the Liquidity and Thorchain model, where protocol actually incentivizes people to run front ends. And I think until we have distributed kind of front end solutions, that's the right that's the right model. So if anything, I feel like it just creates a bounty to decentralize and to make less people use the Uniswap front end, right? To kind of
Yeah.
So
to Jan's point though, like the uni holders up massively. It's trading at like the same airdrop price. So I guess you mean like people who got a big airdrop and they're just like committed to
Or
the
just people who
cause.
bought, like investors are fine. Airdrop holders, I mean, if they held it, I'm assuming very few people have held their airdrop and have traded it. But it's more so just everyone else who bought with some future expectation of a fee switch, which is like a lot of people.
Yeah, I was early. I just want to say I was early on calling no fee switch ever. Like 4 months after they launched, everyone. I was early on that, so I'm taking the W on that one.
I think why I said I was outraged is more on the like just the whole misincentive or like misaligned incentives between like these companies having equity and token, and it's like kind of, and obviously this is like a take from just like a person who likes to invest in like shitcoins and is like looking for good investments and like not a legal one at all because I have no legal knowledge, but it's like more and more teams seem to be launching this way where they have like the equity and the token, and because of regulatory uncertainty or because they can just like have the ability to like kind of like double dip into both, just like end up just kind of screwing over the token. And I think one, it's like kind of bad for, if you truly want some of these protocols to be decentralized, if like all the value capture and all the real decisions are being made at like the equity level, or even with like the Uniswap fee switch, it's like that fee switch vote has been up, I feel like a few times, and like the retail community like overwhelmingly wants it, but just kind of like the team and the VCs behind it, like won't allow it to happen. So from that kind of perspective, it's a bit disheartening.
Yeah, I think it makes sense though if you think, all right, like the regulatory risk is pretty binary to the downside, and then like the slow rug is basically the upside risk, where it's like, yeah, sure, we'll add value to the token, but like you never really do.
Yeah. I'm not saying it's like not expected, it just kind of sucks.
I just think though, like if this were even if this were like a startup, like it wouldn't really make sense to monetize this early, right? Uniswap is what, like 4, maybe 5 years old now. Like it's still a market share game. Like why would they turn on the fee switch now? And they're like crushing it on every metric. Like
Well, part of it is the whole role of the token and its ability to help you gain market share, right? If you use it as an
but they don't do
incentive
that,
tool
right? And have never done that. So
They don't.
like they don't need to add a fee switch to the token. They're getting it. All their volume and stuff is organic. All their liquidity is organic. So I just don't see the need to, like, it would basically shoot themselves in the foot to appease like token holders short term, assuming we don't think it's the right long term like move.
I'm not even saying that they necessarily need to, just like, I guess the problem with that is like someone could come in and displace Uniswap like really quickly, and so like even if they're like dominant market share now, it's like you could just get rugged in the future. Like Uniswap could not exist in like a couple of years from now if like someone comes out with a better model. Obviously they have like a pretty really strong brand and a pretty strong moat right now, but I think I definitely agree with you. Like a lot of these tokens like shouldn't necessarily be distributing revenues from day one, but I think that the ownership between like, okay, what is the token entitled to and like what is the equity corp entitled to needs to be more clarified to.
Yeah, I definitely agree with that.
Yeah. Like you don't need to distribute anything. But yeah, to Duncan's point, like if there was no Uniswap equity, then yeah, Uniswap's token would probably be trading like 4 or 5 times higher, right? Yeah. Because if there ever is like distribution in the future, it's going to the token. But you really, like, nobody really has any idea if Uni will ever be used for anything.
Yeah.
And like that's a problem.
I think this is a situation where like securities laws actually make sense. I think this was Gabe's tweet last week, right? And I do think when there's equity and tokens, token holders normally are always going to get the short end of the stick, right? Because like equity holders have established fiduciary duties. Like it's actually a crime if you screw over equity holders in certain ways, whereas it won't be for token holders anytime soon. And also founders and investors generally have a lot more ownership of the equity than they do of the token, just naturally because of like the distributions. So in general, like definitely not a fan of that model, but worth noting that they were like a pioneer, like one of the early projects where there was really no roadmap as to how to do this stuff, right? And like they've done, yeah, I mean, there's hard to argue they're one of the most successful dApps on chain. So like, I don't know, don't want to overhate on them.
For sure.
Yeah, they get shit on a lot because they're the most successful. Like,
Yeah.
Unfortunately, the nature of crypto is just a lot of anons on Twitter who it's easy to spew.
And it's also just like a perspective thing. Like obviously, like, you know, if you want to try and make money on the Uni token, you're going to be pissed with these decisions. But like, you know, if you're looking from a different perspective, then yeah, you could argue that they, you know, like made a lot of really good decisions. That's just more way.
Their moves are indicating that most of the value of Uniswap is in its brand and in capturing order flow. Unfortunately, the Uni token doesn't own the brand.
Yeah, like you just got screwed as a Uni token.
I'm not sure that's true. That most of the value is there.
But well, you could also argue that most of the value of the Uni token is in the brand, right? There's no actual monetary value of the token.
But especially with Uni v4, like they could really become, I think, even more dominant. Like if people start, and we're kind of seeing it on the venture side, some of the deals we see coming in that would normally be new AMMs are actually just like hooks on Uni v4, right? And I think at that point, with a sufficient like network effect of like hooks building in and all the integrations and stuff like that, I think at some point it will make sense to turn on the fee switch. Even just like, I guess, I don't know if it's even possible to buy enough tokens to like outweigh the investors and early holders. I don't think it is. Which is
You could
pumping their bags.
You could maybe use Uni as like anti-Sybil for solvers that want to solve on Uniswap X. Like CowSwap makes CowSwap solvers have cow tokens, right? So there's different things you could maybe do with it besides just pure fee switch. So I mean, I think that's one of the reasons why it still trades at whatever 5 billion or something high.
We should talk about tokens that are good at some point. So just these equity corporations.
Pretty bullish reaction. I think it was pretty obvious that it was a fake headline within, I don't know, 10 minutes when it was basically just Cointelegraph and no one else. And I think it was just clear to see how many people were kind of caught off sides. And so it kind of depends on, I mean, and now with BlackRock's date being Jan 10th, that's why you see the really high probability for an ETF by then. I think at the very least, you probably see some front running. Seems like BTC is going to kind of suck up the liquidity in the space as well to some extent, aside from like a handful of coins with strong narratives. So, but it seems like a good time to be bullish.
So the reaction was kind of crazy because it's not just that it was off a fake rumor, it's that it was off a fake rumor where the only organization that reported was Cointelegraph, which like 99% you're probably sure it's like not fake if nobody else is reporting this, right?
Sir, they have 2 million followers on X.
Yeah, I think algos. Well, I'm sure a lot of it was algo driven too.
It quickly was on the Bloomberg terminal though and stuff.
But it was a good reaction, like
because we needed that after like the ETH ETF, the futures kind of how weak that was. Obviously, it's not apples to apples. It's a futures and it's not spot and it's ETH. But I think it was a narrative that was certainly going around. It's like, all right, there's genuinely very little demand for it. And then I think it was that plus Larry Fink coming out and that probably was more bullish than the reaction to the headline. Yeah. So you got to imagine they're going ham on sales team.
That's that's the thing that people are not really paying attention to is how crazy the marketing is going to be when these things get approved. Because I've seen Jeff Dorman make this point a lot because there's going to be like 10 approved at once and they're all competing for the AUM. You're just going to be bombarded on every, Sunday night football, Thursday night football,
Yeah.
Morning talk shows. They're going to be going after soccer moms. Like
And
they're
if you
gonna
look
be going
historically, a lot of
everywhere.
these ETFs are winner take all for the most part. Like if you look, like SPY, GLD, a lot of these big ones are winner take most. And so like you're going to see an insane amount of marketing because, getting that market share early on means you're the most liquid and there's just reflexivity there. Um, yeah, so the marketing dollars will be spent. Plus, you can charge a higher fee, right? You assume it's going to be a gradual race to the bottom on fees, but early on, every dollar of AUM in these ETFs is going to be a lot more valuable than a dollar of value in other ETFs because these are going to be able to charge a much higher kind of management fee on top.
No, I definitely think it showed how out of position a lot of people were. 'Cause I feel like right before this happened, like the narrative was like pretty peak bearish, especially with like the ETH future stuff.
How are you positioned, Duncan? Weren't you? I thought you were bearish.
I,
Last I
I
checked.
closed my short after after we like nuked 10% that one day, like a month ago. But I still have like a
Okay.
decent amount of cash, and holding all the good money making coins. But it was fun to see. I'm always here for a green candle on Bitcoin, even if I'm short. I'm happy.
Yeah, I mean, I think like it's clear that BTC obviously still runs the market, and people trying to make it seem like ETH or something can.
Yeah, the ETH futures thing
Not.
was such bad takes.
People want BTC, right? Like, and then that just has massive follow-on effects for everything else. Like,
All right, guys. I think that's a wrap. That's a good episode. Thanks, Matt, for coming on and defending the honor of AMMs. Thought you handled yourself very well.
Cheers.
And yeah, I hope people enjoyed it. And we'll try and do these more often now with our improved sound. Hopefully see you again in 2 weeks.
Bye. Don't get stuck in fiat.
See ya.
See ya. Cheers.
see you later.
Nothing said on the Hivemind is a recommendation to buy or sell securities or tokens. This podcast is strictly for informational purposes only, and any views expressed by anyone on the show are solely our own opinions, not financial advice.